Good afternoon, everyone, and thanks so much for joining us for today's webinar. My name is Mary Ann Hensley. I'm the Vice President of Media Operations here at FreightWaves, and we are happy to present today's webinar in partnership with Redwood Logistics. I'm excited to be here today as we discuss how companies can best respond to economic volatility and minimize supply chain disruption during times of uncertainty, such as the one we're all enduring now. I'm joined by Anthony Smith, who is the lead economist here at FreightWaves, and Mark Yeager, who is the CEO of Redwood Logistics. And they'll be discussing some historical trends during times of uncertainty and how technology can help adapt to changing market conditions. They'll also be joining us for a live Q&A following the presentation. So make sure to send your questions for them through the Q&A button in your control panel. If you have any technical issues during the webinar, you can also reach out to our team via the group chat function in your webinar console. And we will be sending a link to the recording of this webinar if you'd like to view it on demand or share it with your peers. At this point, I'd like to go ahead and turn it over to Anthony to kick off today's presentation. Welcome.
Excellent. Thank you so much, Mary Ann. It's a pleasure to be here with you all. I'm excited to get started. Yeah, we'll just kick it off here without further ado. And so just jumping into things, many of you who may have been on a webinar with me before, and usually I'm accompanied with Zach, and sometimes I'm by myself, but one of the measures I like to look at the most when we're looking at just kicking things off with a broad measure of the macroeconomy is looking at, of course, the GDP. The GDP is a measure that everyone is very familiar with. It's released quarterly. And throughout this webinar, throughout this talk, we're going to look at current conditions, but historical trends, what we can learn from them, and how this is different. And of course, we're going to talk about the different things that are impacting certain segments of the economy, but also I think especially Mark will add a lot of color as to what strategic moves can be made throughout various segments, and what how you can best position yourself and what you should be thinking about as we all navigate through these uncertain times. And with this first segment here, looking at the goods adjusted GDP. And for those of you who are not familiar with the goods adjusted GDP, at FreightWaves, we like to look, of course, at the headline number GDP, but we also like to look at the goods adjusted GDP. And so what that does is it strips out a lot of the noise. And so when we're looking at goods adjusted GDP, it's taking out a lot of the services and things like that. And we're looking at the goods aspect. We're looking at durable goods, non-durable goods, things that are actually tangible, because services don't really move freight. That doesn't really factor into transportation. We're looking at goods being hauled throughout the country. And what we can look at for the latest number through 2020 is that there was a little bit of modulation with the goods adjusted GDP. Of course, we can see the latest huge drop was in, of course, the 08-09 recession. We'll be looking at that time frame very frequently throughout this webinar. But when we're looking at the goods adjusted GDP, it's really important to kind of keep that measure in mind, because that's going to be the make or break for transportation. A lot of times it moves in unison, but sometimes it doesn't move in unison with the overall GDP. The greater macroeconomy could be thriving while the transportation industry is struggling. And we saw some of that in the latter half of 2019 and throughout much of the second half of 2019 altogether. And when we're looking at that, that's going to really be telling when we're looking at the overall health of transportation.
Yeah, I would certainly agree with that, Anthony. I think it's much more constructive for our purposes, if we look at the goods adjusted GDP. There is such a huge services component within the overall GDP calculation, and it's clearly having a disproportionate impact. I mean, I think if you look at the overall numbers and what folks are projecting, it's breathtaking, at a minus 30%. And those kinds of numbers for the month of April. I think when you peel that back and you look at the goods adjusted GDP, we're likely to see a significant tail off, but not nearly to the extent the overall GDP is likely to encounter. Certainly, production and all the other things we're going to talk about later in the webinar are likely to further erode. But for right now, because of the nature of lockdown, I think that it's disproportionately impacting services, and that's likely to continue at least until we can both get back to work, as well as once we are able to sort of resume life as normal, which may in fact be some ways out.
Right, that's exactly right. And talking about looking some ways out, breaking it down industry by industry, I think when we're looking at historical trends and what to expect in the future, I think one of the areas we're looking at the macroeconomy, we're looking at the manufacturing standpoint, that the PMI is going to be an important index to observe. I know many of you are familiar with it. Just real quick, it's a diffusion index. I have it here, one of the components here in the orange line. Anything above 50 is indicative of expansion within the manufacturing industry. Anything below 50 is indicative of contraction within the industry. And so I have that again in the orange line here. And in the purple line, I have industrial goods year-over-year production, or year-over-year change for industrial production. And so when we're looking at industrial production, it's a monthly measure. It's usually a bit lagged, but it tells a very good historical story because it's granular. It breaks down and it's actual accounting for accounting for actual production and tangible goods that have gone, that's been produced and shipped throughout the country. While the PMI really starts to measure almost like a manufacturer's sentiment, right? So when we're looking at it, it takes into account what manufacturers throughout the United States are seeing within their prospective business and their outlet, whether that be automotive, food, bev, or anything that might be consumer facing, things like that. So it really ties together nicely. And what we can see is historically where that red arrow is that when we're looking at the new orders component, it sank a lot more quickly than the actual tangible industrial production number. And it hit that trough a lot sooner than started to rise before industrial production to kind of give us an insights to when production was going to start to come back online and what we can expect from that. Similarly now, almost similarly, we're seeing that drop in new orders. Again, this is given out in different components, different segments. There's a new orders, there's an employment, there's a production, there's a supplier deliveries. And when we're looking at the latest number for the PMI, the supplier deliveries really pulled up the overall PMI. And that's why I suggest looking at the new orders component by itself, standalone, because that might be a little bit more indicative and a little bit more forward-looking and giving us an honest look of what's happening within manufacturing. Of course, there can be a few false jumps up. So it has to be taken not just on by month basis, but what's going on a real-time trend. But when we can start to see sustained decline or sustained rise, I definitely Mark can talk to what that would mean for manufacturing and industrial production. I mean, this is going to be definitely one of the I think go-to measures when we're looking at the state of manufacturing, is really keeping an eye on what's happening with new orders, what's happening within industrial production.
Yeah, I think that's right, Anthony. And this data, shouldn't surprise us, and it's likely, particularly on the new order side, it's likely to get, both sides of this equation will get worse. New orders is certainly likely to be a leading indicator of, what's probably going to be some pessimism out of the marketplace and a little bit of caution. If you remember back to 08, 09, we missed demand forecasting a little bit as an industry, right? And it ended up causing a significant amount of disruption. We under anticipated the fall off in demand, and then on the backside, we failed to really prepare for the upswing in many cases. So we sat on too much inventory and then worked our way through significant, amounts of inventory, and then we weren't ready when the economy was ready to back up. So a lot of people missed that upside window as well. So I think it's important to look. I would certainly be, of the mindset that new orders will continue to show some level of decline. it's pretty consistent with what we're seeing across the board. I will say that as an organization. What we're definitely seeing, most of our customers are up and running. Some of them are shipping less. I would say, in fact, the majority of our customers are shipping less. Some of our customers are shipping significantly more. We do a lot in CPG, we do a lot in healthcare, and they're obviously experiencing unprecedented demand. On the flip side of that are, customers that we have in more discretionary areas and things like auto, where clearly, the plants are in many cases shut down and obviously new orders are limited. We have to be mindful of what happens with new orders because it can have a bullwhip effect that goes all the way back to raw material suppliers. So it's interesting to see how this develops over the second.
Yeah, Mark, and I definitely agree with that aspect of timing and really what's going on within the industry, because as you mentioned, we'll probably touch again on this a little bit later. But when we're looking at just kind of piggybacking off that last tidbit is looking at business investments. And just as you mentioned, this is likely to decline further. Business investment will fall. We're looking at, in the green line here, we have non-defense capital goods new orders, and this is excluding aircraft. And this is another key metric I suggest many of you kind of start to pay attention to if you're not already on a month-to-month basis. But this is going to get refreshed tomorrow, so I'll be interested in and definitely be watching here closely when this gets a refresher. From I believe the Federal Reserve puts this one out. But when we're looking at this number, this is going to be indicative of business-to-business activity. And what we can see is that when there is a lack of business investment, there will certainly be a lack of production as well. So to really go hand in hand, this is just painting a little bit more of a tangible picture that, and really kind of coincides with the story that we saw with the PMI new orders. But as Mark mentioned, manufacturing is timing is everything. And we're really looking at manufacturing specifically. This was already a weak segment when we're looking at the latter half, especially of 2019. In the purple line here, we have industrial production yet again. But in the orange line here, we have flatbed outbound tender rejection index. And so this is one of the measures that we look at FreightWaves to really measure the capacity for different equipment types. We have flatbed, we have refrigerated, we have dry van. But when we're looking at industrial production, we look at manufacturing, we can kind of get to pair the two together. So when we're looking at flatbed outbound tender rejections, that gives us a little bit more of a near-time look because it shows up to the day data or the day before data. So that's near real-time look. So when you pair it with actual monthly trends, the two can really kind of help confirm and tell the story of what's happening in real time and give you a sneak peek on some of these macro releases. But as Mark mentioned, a lot of capacity came online, and they were late to the party when we're looking at 2019. And this was, of course, because of the ramp up of manufacturing and all these goods moving throughout the country in 2018. So we start to see a lot of capacity come online, but it's really a late preparation, right? And so that's where we can start to utilize some of the indices that we went over here previously of looking at when new orders start to come online. And that's when you can kind of start to position yourself in a little bit more strategic way. But when we're looking at manufacturing, this was an industry that was already struggling on a large scale on many fronts throughout the latter half of 2019. And that's because of then, so long ago, a lot of uncertainties that were stemming around the trade war and relationship with China. So with that as our footing in 2019, we were already in a pretty fragile space before the coronavirus pandemic really ramped up.
Yeah, I think that's absolutely right, and it's easy to forget that. That felt like a challenging environment. Of course, what we have now pales, makes that pale in comparison, right? So it's all relative, I guess. But there's no question that the manufacturing economy struggled throughout 19. I think you had seen a somewhat artificially inflated investment level in 2018 due to some of the tax benefits, and certainly our industry, the trucking industry, fell victim to that overconfidence and probably, put too much supply back into the marketplace. So while manufacturing was experiencing softness, you were also seeing an oversupply environment in the transportation space. And this, of course, led to pretty aggressively declining, price environment, within our space. So a lot of the pricing gains that trucking felt like they got in 2019 were given back. And that manifested itself first, of course, in the spot market. And then, it manifested itself and really began to show that in the contract market. So I think it's, interesting. And it's gonna vary by sector. We are not seeing, like within our customer base, one of the things we do is we help customers with supply chain technology. And one of the things we anticipated we would see as we entered this lockdown would be a big pullback in terms of capital expenditures by our customers for technology. We've actually not seen that. We ended up closing eight deals within our platform services group this month. So we are seeing some investments deferred. We haven't seen any investments canceled, by our customers. They are moving forward, at least on the technology side. I would say on the trucking side, I'd be very surprised if we saw any type of near-term rebound in terms of Class 8 truck orders or trailer orders. I think March showed a 50% decline on Class 8 or on trailers and a 52% decline on Class 8 trucks. I would anticipate that that's likely to get worse in April and probably won't turn the corner until we really see that inflection point where demand and supply, get close, at least equal. Right now, we've got significantly more supply than demand out in the marketplace. Truckload ratio is below 1. I think for the first time, we've seen it will take some time before people feel confident about reinvesting, at least in transportation assets. I think on the flatbed side, it's a really interesting slide. Flatbed is obviously, historically tied to steel and to building products, so they are inherently cyclical. With the decline in both those categories, it's not surprising that they're seeing that being impacted in their tender rejects right now. If you're a flatbed carrier, and in fact, if you're a carrier of any kind, you're pretty much taking any load that you can. We too follow those tender rejects data that FreightWaves puts out pretty closely because we feel it really is a good barometer of what's going on in the marketplace. This is a challenging situation for our industry and one not to be taken lightly because flatbed carriers are historically challenged. Their operating ratios are traditionally very high. They have high turnover rates within their employee base. They're most very small carriers. And they are very much challenged with utilization and balance issues. So there just isn't a lot of room for them to see further deterioration, before we'll see a real acceleration in bankruptcy. If that were to happen, it would make recovery that much more difficult in the steel and building products spaces.
Yeah, that's exactly right. And I think, Mark, I'm definitely in agreement there. And then I think when we're looking at the recovery side of industrial production or manufacturing as a whole, there are definitely likely to be some type of incentives needed within that segment. Of course, I think one of the first things that comes into mind is a stimulus of sorts, but it also can kind of come in by way of some type of tax incentive, similar to what we saw in 2018, of course. But that's of course, I think one of the areas that we might see start to come back online. We're looking at large macro industries, in comparison to some, consumer-facing industries. We're looking at sporting events and things that might involve large crowds. Of course, is going to vary throughout the country, but definitely we'll be watching manufacturing and construction closely. And Mark, one of the things that you mentioned just now is talking about that the supply and the demand aspect of it all. And I think one of the things that we're looking at here closely, of course, at FreightWaves is imports. And that's going to have implications to the supply side of everything. And so in the green line, we have maritime import shipments coming from China. And that's for the year 2019. And in the purple line, we have maritime imports year to date. And so what we can see is that in the purple line, of course, it's been trending under that green line, under year ago levels. We did pop up over the year ago levels briefly in the first month of April, showing that there was some growth there and some acceleration. It has since fallen below the year ago levels, but we still see that trending generally closer than what it was in March. And so it does show that there is some imports activity starting to come online again, but it's still far below that year ago level. I think one of the important things that Mark touched on, and maybe he'll expand on a little bit more here, is that there was understandably, I think everyone realizes, a huge shock to the supply side of everything. And so it's important to start to see that there are imports starting to come back online. But we have to also keep in mind that there's a demand aspect to this as well. And we have to keep in mind that there's a shock to the demand side. And although it is, I think, a bit of bright light at the end of the tunnel that we can start to see where ground zero was starting to come back online, that there is, of course, an end in sight, and that this isn't forever, of course. But when we can see that end in sight, it is optimistic. But we also have to remember that there has to be a demand for these goods that China is producing. And so it all kind of has to move in unison, but definitely optimistic to see that there was a surge and a spike up, whether or not that is stemming from the overlapping from the Chinese New Year orders, or it's just more activity coming on. That's yet to be seen and confirmed just yet. We'll still have to look at sailing blank orders and the cancellations and things like that. But it's good to see that at least that there is more activity coming out of China right now.
Yeah, I would agree with that, Anthony. It does look like the Chinese have ramped back up production. Hopefully they're able to sustain that and don't have any type of a setback, but it does look like they're producing goods. I think you're exactly right in that we've gone now from a supply concern to a very real demand. Folks were very concerned if they were going to be able to get goods on the shelves from China. Now, the question is, the goods are arriving, and is there a market for them? Is there demand for them? I think certainly the initial the initial read was pretty optimistic, and you did see a nice surge coming back to the West Coast. Unfortunately, there has been a real uptick in cancellations, and it does look like folks are canceling orders, pretty far in advance, well into the summertime. So that would indicate a bit of a pessimistic view on demand. Once again, may be overly cautious, may just be people really trying to avoid that inventory buildup that was so painful during 2008 and 2009. But at the same time, it is a matter of concern. One thing of interest that we've seen in all of the the disruption that's taken place in this market is the one port that's seen increased activity in, and we don't do a ton of port work or even import work. The port we have seen is Houston, and it appears a lot of this is driven by South American freight, and we're attributing that to somewhat of a shift in terms of procurement philosophies and trying to de-risk the supply chain away from Asia towards some diversification, and with South America being one of the prominent places where folks look to find new suppliers. So we think that is actually impacting Houston port volumes at this point, and that's why they're standing out versus even the East Coast.
Yeah, Mark, I definitely agree. And that's a trend that I really am surprised that hasn't taken hold a little bit more and been a little bit more prominent, is that almost like a nearshoring effect, especially when we're looking at South America or even our North American neighbors and Mexico, seeing how close some of those facilities could be. Definitely will be interested to see how that kind of develops. And definitely, I think that's going to be a huge talking point in the coming months. And one of the things that you mentioned is warehouse capacity and the fear around sitting on a lot of that inventory right now. And looking at the Logistics Managers Index. The LMI is similar to the Purchasing Managers Index, except it looks at the the logistics industry as a whole for transportation. And so this is put out by it's a collaboration attempt by Colorado State University, Arizona State University, University of Reno, Nevada, Rochester Institute of Technology, I believe Rutgers University, if I haven't already mentioned them. So it's a collaboration of those individual universities. And what it does is measures different components of the logistics industry. And looking at this specific component, we can see that capacity is falling. So we can start to see that a lot of those warehouses inventory was starting to build up throughout the month of March. Of course, we're going to get March was a very volatile month, even within the week-to-week movements. So it'll be very telling to see what the April results are. But again, this looks at not just manufacturing, but the consumer side of things as well. So as Mark mentioned, it's going to be, I guess, it's definitely going to be a bit of it's going to be interesting to see how inventory is managed and what's being pulled forward, what there's being preference to, and what kind of orders are being put in, especially when we're looking at international shipments. As I'm sure there will be a variety of pull forwards. And when we're looking at the consumer side of things, of course, we had a drastic pull forward for many consumer goods throughout March. We saw a lot of panic buying and really a lot of attempts to keep up with that. I expect some of that to really ease when we're looking at the amount of goods being purchased on the consumer side. Purely one side is from the psychology of it all. When we're looking at the mindset behind panic buying, some of that is likely to subside within different regions and different states. The other aspect of it is going to be quite frankly, we'll get into it a little bit later, but employment opportunities and jobless claims. And so a lot less discretionary spending. But Mark, definitely an area that you mentioned is going to be one close to watch. It's going to be what's happening with warehouse capacity and how that's being managed in the coming weeks and months.
Yeah, I think it's going to be very interesting. It's been a very dynamic space anyway. Warehousing has changed, fundamentally over the years and as of late. Above and beyond kind of technology and robotics and all that kind of stuff. What you're really seeing is a significant shift to try to accommodate, predominantly e-commerce and consumer expectations about fulfillment, right? So a lot of the footprint of the industry is in flux, in transition. There's also been huge emphasis within the industry to try to really maximize capacity and really make full utilization of your space and that kind of stuff. So there isn't a tremendous amount of flex capacity that's out there within the warehousing environment. So even the slightest kind of miscalculations from a demand perspective, could have, pretty significant impacts and could certainly make for some real price volatility when it comes to, getting warehouse commitments. I think it's going to be interesting to see. We may be pleasantly surprised with some commodities. There is definitely speculation, and I've read about it in FreightWaves and in other places that, folks are going to be getting a little bit of an influx of money. It's not a significant amount, but it's a little bit. They're not going to be able to spend on traditional discretionary activities like travel and entertainment. There's probably going to be a reluctance to do a lot of dining out, and there won't be an option for sporting events and concerts. Maybe some of those consumer discretionary dollars will go towards goods, and those goods will, in fact, get through the system and out of the warehouses and onto the shelves and to our consumers faster than we're anticipating. I wouldn't make a big bet on that theory, but it could have an incremental benefit.
Definitely. And one of the aspects that you just mentioned is going to be right here on the consumer side of things. And that's really going to be on the retail sales aspect of it all. And so we just got a refresher for another large macroeconomic measure, retail sales, for the month of March. And this was the steepest drop ever, as expected. But we can see historically, this was a single month drop that took quite a few months in '08 and '09 to kind of get to. And so this was really a drastic decline. We're looking at the movement of retail sales. And now, of course, this was not really equal across the board. We're looking at, of course, department stores that took substantial hits, double-digit decline, I think somewhere well over 20% decline. And we're looking at food and beverage stores, so grocery stores, that was well over the month ago level and over the year ago level. I think that's all well over a 20% month-to-month rise. And so that's going to be an area to kind of keep an eye on to see, as many states talk about reopening throughout the month of April and into May, what type of recovery is seen there. I think historically, we were looking at retail sales. There was already a shift happening, right? And so when we saw that within retail sales, there was, of course, this huge ramp up in e-commerce. Of course, that is going to begin to become a lot more prevalent throughout the industry and the economy. But we're looking at retailers, those large big box stores, of course, like JCPenney's, Macy's, and stores like that. I mean, those stores were already a bit struggling. And so the coronavirus pandemic could really start to accelerate the need for them to either, continue to adapt to the new environment or to fade away. And there are a lot of underlying trends that are kind of starting to emerge from this. I mean, one of the areas that we saw previously that was really kind of struggling to make a dent, as many was expecting, were home deliveries of groceries. Now that's really kind of starting to ramp up a lot more after a lot of speculation and suspicions around that whole idea. Now that's really starting to grow. We can expect to see that the environment for e-commerce and the environment for retail to change and alter, especially when we're looking at the large players in this market. We're looking at Target, Amazon, Walmart. They're likely to become a little bit stronger after this whole pandemic because we're seeing the diminishing of many small businesses or mid-sized businesses as potential competitions or competitors. That's going to really start to kind of build into their favor a little bit more as we're moving throughout the year, especially when we're looking at the recovery side of things. But I think definitely when we're looking at the retail aspect, it's going to be, of course, different across the board, but overwhelmingly a decline, especially when we're looking at traditional retail sales. We're looking at those goods that are considered non-essential, clothing, department stores are going to get hit hard, but likely to recover as more discretionary spending kind of starts to ramp up a bit more. An area that might be a bit volatile in the coming weeks and months could be building material supply stores. And so looking at Home Depot and Lowe's and things like that, especially as I think those of you that might be located in the Southeast might be experiencing quite some hard weather, whether it be flooding or tornadoes in certain areas. This could be a potential area that could spike and then have its subsequent declines. But I would suggest kind of looking at different verticals within retail sales to kind of leverage being able to stay active, of course, but definitely going to be an environment and a landscape that's going to be changed by what's going on right now and vary from historical trends.
Yeah, I mean, I think that makes total sense. Yeah, the uptick in DIY, would make some sense. I know I've certainly never spent so much time at home, and I had no idea, how many projects were out there. Whether we get around to those is another matter, but it does. I think you're going to see more dollars directed towards home and fixing things and making it a better place to live, and less directed towards extracurricular activities, simply because people just aren't as comfortable engaging in those kinds of things. I think as you look at retail, there's no doubt, you're absolutely right. We've been at a tipping point, if you will, within retail as it is. This is very likely to lead to fairly significant consolidation. It's probably also, unfortunately, going to lead to a fair amount of store closures. That gap will be filled. It will most likely be filled, at least in large part, by larger players, and hence the consolidation theory. We've certainly seen all this hold true. Our grocery customers are booming. Anybody that's selling essential household products is going through significant demand. A lot of that will back off. We may not sell another roll of toilet paper for 10 years, but certainly I think they're faring much, much better. And then this e-commerce side of the retail equation is also, doing well. And you have to believe that now that folks are really comfortable, with getting groceries delivered to home and things like that, this will really accelerate even faster, than it has been. So there's going to be losers in all of this. There will be a few winners. I suspect that the e-commerce side is going to gain, significantly more momentum and at the expense of conventional brick and mortar, especially struggling with their brand identity.
Definitely, I definitely agree there. And of course, I think the big backdrop of all of this, and it's been on headlines almost every Thursday, and that's going to come by way of jobless claims. And throughout a lot of this webinar and this presentation, we've been kind of talking about the new trends and how it compares to historical trends. This is quite frankly unprecedented, and we just got the latest numbers. So last week, initial jobs claims was 5.25 million. We just got numbers this morning showing that another additional 4.4 million Americans applied for initial jobless claims in the last week, and so that brings the total up to at least 26 million individuals throughout the U.S. that have applied for initial unemployment benefits since the outbreak of the coronavirus pandemic, and that's really kind of spanning over the last 5 weeks or so. And in comparison, we see a small little blip up in the 08-09 or that 09 area of jobless claims, and so that really talks to the impact overall that we see with the current situation. Is, of course, is going to talk to a lot of sheltering in place and the closure of non-essential businesses. But even with, of course, many have started to receive stimulus packages in the mail or directly and deposited to their accounts, and a boost in week-to-week unemployment benefits. That should help assist many Americans throughout the country on making those essential payments. There's also, I think it was a $600 boost in those week-to-week payments as well. So that should assist a lot of individuals. But the unprecedented job claims is something that we have not seen the likes of before. I guess the spot of good news is that the number of claims are starting to come down, but you have to kind of keep in mind that, these are still new Americans that were employed the week before or seemingly employed the week before applying for jobless claims. So the number is coming down, but you still have to look at the number as a whole, and that totals to at least 26 million. So when we're starting to look at the back end of this, the recovery side of this, there's another measure that the Labor Department puts out, and that is continued jobless claims. And so these are individuals that are continuing to apply for jobless claims on a week-to-week basis. So these are showing that when we're watching this number, when we're watching continued claims, that's going to be the area to show whether or not employees are starting to enter the workforce again. So I'll be watching that one very closely. But really, when we're looking at historical trends, this is really uncharted waters here. We're looking at overall jobless claims here.
Yeah, there's no question. It is a new, by a multiple, right, of previous records, and not in a good way. It's hard to imagine that 4.4 million jobless claims in a week would be perceived by Wall Street as good news. But if you look, what happened, after the announcement, people felt that was better than what they had been expecting. And that is, that is breathtaking. It's hard to imagine, and it is across multiple sectors. This isn't just restaurant workers, right? I mean, this is really reaching across. I saw an interesting breakdown, and major job losses in core industrial functions, and, transportation and logistics. The number I saw was 1.4 million jobs lost. That is huge, very, very significant. To me, the one bright side, in all of this, when you compare it to 08, 09, is that 08, 09, started in the housing sector, migrated into a banking crisis. We didn't have good access to capital. That right now is not the case. We do have access to capital. The government is responding with some fairly significant assistance. Now, whether they're going to implement that appropriately and get it to the right hands is another question, right? But there is the opportunity for us to step in, provide capital to the small businesses that need it and the big businesses that need it, but really step in and bridge that gap. Do that successfully, most of these jobs, will return, and we'll be back in single-digit unemployment by year end. If we don't do that, we're going to see a lot of business failures, and we're going to have, record high unemployment levels that look, something like the Great Depression.
Right, Mark, and as you mentioned, this is throughout various industries, and of course, the service sector is getting hit hard. But as you mentioned, manufacturing, industrial as well, trucking, and I think there's going to be two sides to this, right? When we're looking at, anecdotally, I've heard of individuals that may have been receiving now more from the unemployment benefits now than they were actually making previously, and so that might incentivize a few to stay out of the workforce a little bit longer. With any kind of government subsidies or programs, those are always the easier part is kind of getting it passed, even though that seems like a struggle at times between House and the Congress. But the hard part really a lot of times is taking some of them away when we're looking at different subsidies and different programs and things like that. So I think it's going to be interesting to see the rollout of recovery, what kind of incentives they're going to be put in place for individuals to kind of push and prod them to get back into the workplace, and push and prod and assist some of these small businesses and large businesses, as you mentioned, that would employ these individuals, because that's the other end of the spectrum as well. And the other thing you mentioned is we are, I think, in a much more stable trend than what we saw in the 08, 09 time frame. As you mentioned, it came from housing and started to turn into a banking crisis and financial crisis and meltdown overall. And really, we weren't on good financial or economic footing. As you mentioned, we are in a much better place now. We're looking at specifically housing and construction. Housing never really fully came back to the levels that we saw pre-08-09 recession. There was a tepid, steady rise over the past few years when we're looking at housing construction. We're looking at new homes coming online. But we saw in the most recent month of May, there was an understandable drop, a decline of around 22% on a month-to-month movement from February into March, and from the U.S. Census Bureau. And so that is going to be impactful for the amount of inventory on the market. We're looking at new homes. Existing homes also declined. I think it was somewhere around 8.5% or so in March. Of course, March, very difficult month overall to kind of get a grasp on overall. But when we're looking at the housing segment, this was an area, a bright spot of the economy throughout the tail end of 2019 and going into 2020. A lot of that came to there being a pretty substantial decline in the supply. There was a lack of supply for available lots. There was a lack of available labor. And those two aspects really kind of diminished the amount of available lots to be built on, and a lot of production that would come online. A lot of this was really built around initial or first-time home buyers. So entry-level homes were in really big demand. Those are still going to be, I think, in demand when we look at the other side of this thing. But this is really going to be an area that's going to hurt because we finally start to hit our stride. And of course, I think when we're looking at existing homes, it's not going to be as impacted, I don't think, on the pricing side. We're looking at that just because I think individuals are going to start to take their homes probably offline, practicing social distancing and sheltering at home. Maybe they don't want to have more and more individuals in open houses and things like that. They don't want to invite more individuals in their home for potential health reasons and things like that. So that would take away from the supply side and take away from inventories. That should kind of keep prices propped up pretty nicely. Of course, it's going to be on a region by region and state by state level. Of course, Northeast and New England area are going to be hit a little bit harder than Midwest and some areas in the South. So looking at housing is definitely a far cry from where we were in 0809, but still a far cry from where we were even before then.
Yeah, I think that's right. I mean, I think you could certainly argue that pre-0809, that was a bit of a feeding frenzy, and that kind of led to a lot of bad things. At the same time, it has been a steady climb back, and it is most unfortunate to see, what are the real, sort of bright spots, I thought, really, of the poor economy. Really making some solid progress. And obviously, when you think about housing, it's kind of the ultimate, consumer confidence decision. And, people who are out of work or concerned about their jobs are much less likely to look to make any kind of change, let alone a significant investment. So I think this will be one of the slower areas of the economy to recover.
Right. And Mark, I think you hit the nail right on the head as we're looking at the consumer aspect of it all. And that's what we have here lastly is that consumer sentiment. And what I have here is the Home Purchase Sentiment Index. I think it's a very underrated measure for consumer confidence and consumer sentiment. Of course, the big headline numbers, of course, I watch frequently coming from the conference board that I believe they put out the Consumer Confidence Index, and the University of Michigan puts out consumer sentiment. Looking at the Home Purchase Sentiment Index from Fannie Mae, it is built around the housing market, but it has different components to it. And so it asks whether or not you feel confident about your job prospects over the next 12 months, whether or not you think it's a good time to buy a house or sell a house, whether or not you think mortgage rates are going to go up or go down, or the other aspect of whether or not you think your income is going to go up or go down over the next 12 months. So it has some forward-looking components to it. And quite frankly, when consumers, as you mentioned, are feeling confident to embark on these large financial endeavors, they're feeling confident about other aspects as well. And so even if they're not purchasing a home, they're making other big ticket purchases, or their discretionary spending is coming up a lot more. And so when we're seeing that also feeds into, of course, freight volumes when you're, either you're buying a house or making the additions to our existing homes, or you're filling that new home up with goods, furniture, appliances, and things like that. That all kind of feeds into the movement of goods throughout the economy. And so throughout the next couple months, I will definitely be watching and monitoring the Home Purchasing Sentiment Index closely. And Mark, just as you mentioned, this is going to be, the consumer confidence aspect of it all is going to be really pivotal to the growth and the recovery for the economy coming out of this thing.
Absolutely. I couldn't agree more.
Awesome. Well, thank you guys both so much for sharing your insights. At this point, we would love to go ahead and take some questions from those of you listening in the audience. So if you have not already submitted those, you can do so using the Q&A tab in your control panel. For those that we may not be able to get to today, we will be glad to follow up with you offline after today's session as well. So don't hesitate to send those in. First question, are you seeing any trends in cross-border shipments due to the increase in B2C e-commerce?
So that, on my end, I definitely will have to follow up with Henry Byers, our in-house maritime expert. On my end, we haven't seen. I haven't seen quite a lot on the e-commerce cross-border shipments just yet. But again, I'll have to follow up with that one on our in-house maritime market expert, Henry Byers. But from a large scale, macro scale, looking at retail sales and looking at specifically e-commerce, that was one of the few segments that did maintain a positive month-to-month movement and hasn't gone below the year-ago level. So I can only imagine that there will be more cross-border and domestic shipments when we're looking at that segment.
Yeah, I think, we've seen, I don't have it stratified out by e-commerce versus, conventional commerce. I think we've seen solid cross-border traffic. It certainly was, in some ways, I think, hindered by a less than clear view of how the Mexican government was going to be able to handle this situation. Clearly, there's been some very serious issues with Mexican plants close to the border, and I think that's impacted in some way some of the volume levels that we've seen in terms of cross-border. Longer term, though, I would agree with Anthony. I think you're going to see folks looking to de-risk their supply chains. And one way you do that is find different suppliers in either closer geographies or more stable geographies, right? So I do think you're going to see a significant amount of effort to nearshore, and certainly Mexico would be a logical beneficiary of that.
Awesome. Thank you both. And next question, what indicators have you seen that domestic manufacturing is increasing? Anthony, we can start with you.
Sure. So when we're looking at domestic manufacturing, one of the areas I like to look at is the regional Fed index releases. And so there's things like the Empire State Index, there's the Philly Fed, the Dallas Federal Survey. And so all of these measure manufacturing at a state level. And so these are all survey-based indexes. And so when looking at that, of course, a lot of them have greatly declined. But when you observe some of those, I think those are going to be the ones to watch for increasing domestic activity. From the manufacturing standpoint, of course, those are also broken out into different components. So the new orders, the production, and things like that, but much more on a focused by state basis. So I definitely suggest and encourage looking and observing those Federal Reserve regional surveys.
Yeah, that certainly makes sense. We certainly, right now you can't really point to any positive manufacturing data, right, that's out there. But I do believe that you're going to see folks who want to get away from the Asia strategy to a certain extent and bring it back to the United States. It's going to be imperative, though, that we're able to find ways to compete with the labor advantage that's in Asia. So I suspect you're going to see a lot more investment in robotics and automation and those kinds of things. So I don't think this is a simple, for most supply chains, most shippers would love to go to a U.S. supplier base right now, but it just doesn't exist. And the manufacturing capacity isn't something that just comes online quickly. So I think that'll be something that evolves in the course of time.
Awesome. Thank you. Next question. As imports appear to be rising somewhat, which ports are positioned to see volumes rebound?
On our side, so of course, before all of this, we saw a lot more volumes on the East Coast when we saw, looking for alternatives throughout that trade war situation. As of now, I believe the West Coast ports were a little bit more active as of late, especially when looking at the overall trends that are happening on the East Coast right now. So again, we did see that sudden ramp up in earlier parts of April, but it's going to be telling to see, is this going to be a sustained rising situation as we move throughout April, or is this going to be kind of a hangover effect from the Chinese New Year and orders that were put in months ago that are finally starting to come back online? But my guess would be that we'll start to see more activity on the West Coast, potentially on some of that port activity, even though much of California is getting hit hard, similarly to New York as well. But that's why I'll be watching closely, is going to be the West Coast ports.
Yeah, I mean, you certainly, the West Coast ports sort of drive the economy. There's no question about that. It's the logical jumping off point for most Asia freight. Personally, though, I tell you, I do think that the trend that we've seen the last few years of going through the canal, now that it's able to handle the larger vessels and going closer to the ultimate consumer, is likely to continue. I think a little bit of that bump up to SoCal in the last few weeks is somewhat attributable to a desire to really minimize transit time, because obviously when you go through the canal, you give up fairly significant amount of time to get goods ultimately to market. And given the shutdown, I think people were, disinclined and to make that trade-off. Right? I think we might have seen a bit of an artificial bump in terms of that post. There's still no doubt that Southern California ports are, the major player in North America, and that's going to continue for a long period of time. As I mentioned, we have seen Houston pick up at largely South American freight, so that could be a trend that continues and brings more activity into that area of the region.
Great. And next question, what are your thoughts on automotive sales? If remote working becomes more common, car usages are dropping at an alarming rate.
Yeah. So I think automotive is definitely going to be it has been a deeply impacted sector already, what we've seen in March. And keeping true to the theme of much of this, looking at historical trends, when we're looking at 08, 09, there were a ton of measures and incentives rolled out by many of these automotive producers. We're looking at, trade-ins that were kind of put into a favorable standpoint for those that had a trade-in, or some type of assurance program where we saw that there was going to be some forgiveness if you were unable to make payments on a monthly basis because you lost your job or something like that, or if you felt uncomfortable with your current payments. I think there were some producers or manufacturers that would take the keys back if if that's what you wanted to do, no additional charges. So I think when we're looking at automotive, I think, again, we're going to start to see creative incentives put in place here, whether that be really long-term, low to zero interest rates put in place. So I think when we're looking in the coming weeks and months, those are going to probably start to get rolled out again, just to kind of encourage and really kind of boost up that activity again, especially when you're looking at where we were already going and heading towards in the automotive industry, right? We're looking at low emission vehicles really being popular, crossovers. Now that was really a big trend in 08, 09, is looking at crossovers that were in not specifically just heavy duty vehicles, but in a sport utility vehicles. I think the big thing now is, of course, electric vehicles. And so I think we're looking at more hybrid and low and high efficiency vehicles. Those are probably going to receive a lot more incentives to encourage purchasing and trade-ins.
Yeah, I think that would be money well spent too. Really getting behind some incentives here. Clearly, money is cheap, and so it is a good time to finance anything, including a vehicle purchase. But it is once again a benchmark of consumer confidence. To me, I think that it's probably going to be one of the slower recovering sectors. Certainly, if you look at what's going on in China, they're struggling with auto sales, and that's hardly surprising. It's still not enough time to really get a good sense of that. I've got a crazy thought, on this. I mean, I really think that with all of this going on, there will be an interest in finding alternatives to conventional vehicles and alternatives to public transportation. So this could also be something that greatly encourages the acceleration of autonomous vehicles. Something I think is still a long ways away, but I do think is an eventuality. It's a matter of when, not if.
Awesome. Thank you, Mark. And we have time for about one more question here that I will go ahead and field to you, Mark. It says, clearly demand is going to be very erratic and unpredictable. So how are logistics service providers going to adjust to that? Will they still consider new technology, which will make them more efficient and cost effective, or will most have an aversion to any kind of spending? What are your thoughts?
Well, so I think, as I was mentioning, one thing that has really surprised me is the ongoing commitment to technology investment that we've seen out of our customers. And I know certainly at Redwood, we're continuing to invest in technology. It's a major emphasis for us. We think that, that returns from thoughtful investment in technology are tremendous. In the process of launching Redwood Connect is our integration platform, and it's been a significant investment. But the way it positions us with our customers and with the industry, we think is certainly money well invested. I think other 3PLs are going to view it that way, and I think on the shipper side, the democratization of technology has been a game changer. You talk about things that are different, 08, 09 versus now. And really there's fantastic tools available to even small shippers, let alone mid-size and larger shippers, that can be implemented, fairly quickly and at, with modest investment. So to me, the price of technology is coming down and the impact of technology is going up. So I suspect we'll continue to see a lot of momentum behind investing in supply chain technology.
Absolutely. And thank you so much, Mark. It looks like that is all of the time that we have for today. So thank you to everyone so much for taking the time to listen in this afternoon. Of course, thank you to Anthony and Mark for being here to share your insights. And thank you to Redwood Logistics again for partnering with us on today's presentation. We've had a few of you ask if the recording would be made available, and it will. You will receive a link to the recording of this session via email, the email that you used to register for the webinar today within the next 24 hours. We appreciate you all being here and hope you'll join us again for another webinar soon. Have a great day.